Today, we will talk about crypto trading strategies, how to beat the market and maximize profits. The world of crypto trading is often merciless. Rapid fluctuations can turn a profit into a quick loss. Thus, controlling your emotions when trading cryptocurrencies is crucial to success. Many traders attribute their success to the years of experience they have. However, the key factor that determines your crypto trading performance is your capability of controlling emotions. A single emotional mistake can quickly ruin your trading profits. Furthermore, many traders experience a negative spiral of emotions, stacking emotion-loaded trading decisions. For that reason, controlling your emotions is one of the key aspects to maximizing your crypto profits. This video discusses how you can leverage the power of setting targets and planning to improve your emotional control. Further, we introduce different selling strategies to increase trading profits. Make sure to read this video to the end, as we've included a bonus section with some insider tips. 1. Avoid FOMO and control your emotions. It's crucial to understand different emotions exist and can affect your crypto trading decisions. Here are the 3 most common emotions. Fear. Crypto's native volatility is a major reason for sparking fear among traders. Often, traders use uncomfortably large stakes when trading crypto, which has a big impact on their stress levels. Therefore, trading with improper trade size magnifies emotions and so generates more feelings of fear. This is particularly dangerous as fear is one of the driving motivators for making incorrect decisions. Conviction or excitement. According to the Google Dictionary, conviction describes itself as a firmly held belief or opinion. In other words, you are excited about a certain project, not being able to see the disadvantages or shortcomings. You firmly believe in the success of a project, almost in a dogmatic way. You can quickly spot such emotions with other people when they neglect or reject any criticism a project receives. Greed or overconfidence. The feeling of greed or overconfidence can have pernicious side effects. You feel as if any trade works out well. The feeling of overconfidence can be sparked by a series of correct trades. However, we should also take a look at market cycles. A market can reside in a feeling of optimism, thrill, or even euphoria. In such type of market, it's much easier to make profitable trades. However, when market psychology changes to more negative emotions, such as anxiety or panic, a feeling of overconfidence can get you quickly in deep losses. So how can you effectively control your emotions? A golden tip is to reduce your trade size to reduce the effects of feelings such as fear. When it comes to excitement and overconfidence, you have to learn to understand your own emotions, but also understand market cycles. For example, the whole 2020 DeFi hype has rocketed the crypto market to a feeling of optimism. 2. Make a plan. Sounds simple, right? Creating a trading plan requires minimal effort but has a much larger impact on how you approach crypto trading and helps you with controlling emotions. A plan can give you boundaries and targets. Those boundaries and targets make it much easier to make the right trading decision as you have a plan to fall back to. 3. Set targets. The importance of a stop loss and take profit. Let's discuss 2 important trading instruments, a stop loss and take profit. First, a stop loss prevents you from losing more money than you want to. For example, you open a trade you expect to be successful. However, the volatile nature of today's crypto markets can quickly set you at a loss. Therefore, a stop loss allows you to set a floor for your trading position. However, watch out when determining the right stop-loss position. It's important you give your crypto trade plenty of breathing room. As crypto is very volatile, the price can fluctuate a lot. Therefore, when you set a very tight stop-loss at 5% below the opening price of your trade, you might find out that your order got closed even though that your trade turned out to be correct. Look up the volatility index for the cryptocurrency you are trading. This gives you a better indication of where you can safely set your stop-loss to give your trade plenty of breathing room. Next, let's discuss the importance of setting a take profit. A take profit actually serves as the ceiling for a trade. A take profit will automatically close a trade at the predefined target price. Again, you also don't have to monitor the charts every minute of the day to sell a crypto trade at the right moment. Now, you may wonder why both stop loss and take profit are important. Well, they help you with setting fixed targets. In other words, you don't have to stress about when to sell a crypto trade as you've set both the floor and ceiling for that trade. 4. Don't try to sell crypto at the top. Try percentage-based selling. Do yourself a favor by not selling all your crypto at the top. Many different strategies exist, such as percentage-based selling, to assist you with effectively selling crypto to cash in profits. Do yourself a favor, stop trying to get out at the top. First of all, selling all at once puts you under a lot of stress. Suddenly, you've got a large sum of spare money at hand, which you likely want to reinvest. Again, this increases stress as you want to quickly find a good trading opportunity, creating more room for mistakes. Therefore, let's discuss how percentage-based selling works. Percentage-based selling complies with the rule of not selling all at once. In contrast, you want to sell portions of your trade when certain targets have been met. For example, sell 50% of your trade volume when your trade hits a predefined price target. However, we don't want to sell everything as the stock might continue to rise. Why throw away a winning horse? Therefore, we set different selling targets to sell smaller percentages of our total trade volume. 5. Be mindful about resistance levels. Resistance levels play an important role in traditional and crypto trading. They act as psychological borders for traders. It's one of the easiest indicators traders agree on, so respect those borders. According to Investopedia, a resistance level can be described as the price at which the price of an asset meets pressure on its way up by the emergence of a growing number of sellers who wish to sell at that price. To give a bad example, you detect a trading opportunity by looking at the RSI indicator. However, you aren't mindful of resistance levels and buy in at a price of $100. You haven't noticed there's a months-old resistance level at $102. Therefore, it's very tough for that cryptocurrency to push through this resistance level. In conclusion, you opened a bad trade as the price is most likely to go down and hit your stop-loss target. What do you think of our video? Let me know in the comment section below. Before you go, please hit the like button and subscribe to my channel. Thanks for watching.